Hey everyone, welcome back to Canada Accounting Insights. Today we're diving into a fundamental topic that every CPA student, aspiring auditor, or accounting professional needs to master: audit risk and risk assessment. Before we get into it, don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss a new lesson. All right, let's get started. Let's begin with the big question. What exactly is audit risk? Audit risk is the risk that the auditor issues the wrong opinion on financial statements that are materially misstated. In simple terms, the risk that something important is wrong and the auditor doesn't catch it. The goal of every audit is to reduce audit risk to an acceptably low level so that the auditor can confidently issue an opinion. And to understand how this works, we use what's called the audit risk model. The audit risk model shows the relationship between three key components. Audit risk equals inherent risk times control risk times detection risk. Let's break each one down. Inherent risk IR. This is the likelihood that a material misstatement exists before considering internal controls. It's driven by factors like the nature of the business, complexity of transactions, estimates, industry conditions, and external pressures. Neither the auditor nor the client can control inherent risk. It's built into the environment. Control risk CR. This is the risk that a misstatement won't be prevented or detected by the client's internal controls. Control risk depends entirely on the strength and effectiveness of the entity's internal control system. Detection risk DR. This is the risk that the auditor's procedures fail to detect existing misstatements. Unlike the other risks, the auditor controls DR through the nature, extent, and timing of testing. Lower detection risk means more substantive testing, larger sample sizes, more experienced staff, everything you'd expect when risk is high. Here's the key relationship you must remember. If risk of material misstatement, RMM, is high, then DR must be low. If risk of material misstatement, RMM, is low, then DR can be higher. Auditors always set audit risk as low. So when inherent risk and control risk go up, detection risk must come down, which means more audit work. On the other hand, for low-risk clients with strong controls, DR can be set higher, allowing the auditor to reduce detailed testing. Let's walk through a simple example. The external auditor of Harborstone Financial, a small financial services firm, is completing the risk assessment. Inherent risk is assessed as low. The company has strong internal controls. The auditor plans to rely on those controls, meaning control risk is also low. Since IR is low and CR is low, the auditor can accept a higher detection risk while still maintaining an overall low audit risk. What does this mean in practice? Less detailed substantive testing, the ability to rely more on controls. A more efficient audit, that's the power of the audit risk model in action. The risk of material misstatement, or RMM, is made up of RMM equals inherent risk times control risk. Auditors must identify and assess RMM at two levels: overall financial statement level and assertion level. Let's look at both. RMM at the OFSL includes pervasive risks that affect the financial statements as a whole. Here, auditors consider the entity's organizational structure, industry and regulatory environments, business model and use of IT, financial performance measures, accounting policies, internal controls. RMM at this level can be increased by factors like poor financial health, intense market competition, a first-time audit, complicated transactions, major financing arrangements, employee bonuses tied to earnings. Just as important, auditors must also identify factors that reduce risk, such as fewer users of the financial statements or strong oversight. Let's move to our next company example, BiteWave Solutions, a software development firm completing its second year of operations. Here are some OFSL risks the auditor identifies. Risks that increase RMM, first-time audit. Opening balances haven't been scrutinized before. High debt load and losses, creates pressure to present results more favorably. Complex software contracts, revenue recognition and development costs can be challenging. Risks that decrease RMM. Private company, fewer external users lowers pressure to manipulate results. Strong board involvement. Oversight reduces the possibility of material misstatements. These factors give a balanced, realistic picture of risk at the overall financial statement level. Control risk at this level considers pervasive control weaknesses or strengths, such as outdated accounting systems, poor segregation of duties, weak IT controls, lack of internal audit, management override, no clear policies or procedures, and again, the reverse of each can lower the risk. Continuing with bite-wave solutions, CR factors that increase risk, lack of policies and procedures manuals, higher chance of errors. CR factors that decrease risk, strong board oversight, increases accountability. Good segregation of duties, reduces opportunities for fraud or undetected errors. These control risk factors help the auditor determine the reliance on controls and the required level of substantive testing. Once OFSL risks are identified, the auditor responds by emphasizing professional skepticism, assigning more experienced staff, increasing supervision, adding unpredictability to the audit, adjusting the nature, timing, and extent of procedures, testing additional locations if needed. These responses help ensure the audit remains effective, even when risks are high. At the assertion level, risks relate to specific accounts or transactions, such as revenue, accounts receivable, inventory, payroll, intangibles, financial instruments. Auditors must identify relevant assertions, assess inherent and control risks separately, and determine whether any risks qualify as significant risks. Inherent risk at this level considers complexity, estimates and judgment, subjectivity, unusual transactions, susceptibility to fraud, industry-specific challenges. Again, some factors may reduce risk, such as routine, predictable transactions, or stable account balances. Here are some assertion-level inherent risks the auditor identifies. Development costs. There's risk around whether certain costs should be capitalized or expensed. Incorrect treatment could materially misstate intangible assets or expenses. Revenue. Contracts depend on software delivery, expected in a later period. There's a risk of premature revenue recognition, a classic audit concern. Administrative expenses. These are routine and predictable. Because there's little judgment, the risk here decreases. These examples show how IR can go up or down depending on the nature of the account. At this level, auditors look at specific controls affecting specific accounts, including authorization controls, physical controls, IT access rights, segregation of duties, controls over journal entries, controls addressing significant risks. If the auditor does not plan to test controls for a specific assertion, then CR is simply assessed the same as inherent risk. Here's what the auditor identifies. Controls that decrease risk. The board performs detailed reviews of software development costs, increases reliability of intangible asset balances. Controls that increase risk. The CEO has full access to the payroll module while also approving payroll, increases the opportunity for manipulation. These findings directly influence the amount of substantive testing required. Risk assessment isn't a one-time step. It's iterative, meaning auditors update their risk assessments as new information becomes available throughout the audit. The goal is to ensure that all significant risks are identified. Audit procedures are designed to address them. Audit risk remains low. The final opinion is appropriate and well supported. This is the foundation of a high-quality audit. Before we wrap up, here are the major takeaways. Audit risk equals IR times CR times DR. Auditors always aim for low audit risk. RMM equals inherent risk times control risk. RMM is assessed at both the overall financial statement level and the assertion level. Inherent and control risks can either increase or decrease based on case facts. Detection risk is the only component controlled by the auditor. Strong controls equals higher DR, allowed equals fewer substantive tests. Weak controls equals lower DR, required equals more audit work. Risk assessment is ongoing, not a one-time step. And that's it, a complete breakdown of audit risk and risk assessment. If you found this helpful, make sure to give this video a thumbs up, subscribe to Canada Accounting Insights, and drop a comment if you'd like to see more audit-related videos. Thanks for watching, and I'll see you in the next one.